Thank you for joining me on What's Hot and What's Not for the month of February. This video was filmed on Sunday, January the 31st. We're also going to take a look at the what happened last week in the markets. It was a crazy week last week, lots of stuff going on. We'll take a look at what to expect in the upcoming week and also in the month of February, where February stands as a month for the broad markets relative to other markets in performance, and also what sectors of the markets tend to do well in the month of February. Okay, before we get into that, let's take a look at what happened in the price action of the S&P 500 last week. You can see here that the S&P 500 did break out of this channel that I've been talking about over the last few weeks. We did have a little bit of a breakdown here. Nothing really much of a concern. We're still just a little bit off the all-time highs. And really, I think is if we get down below this level that we saw, just below 3,550 around that area, which was the October high, and that because that's a double bottom breakout, the peak right in the middle there. And I think also too, if we break below 3,600 as well, I think investors might start to get a little concerned. We're not there yet. From an RSI perspective, we're not at an oversold basis either. It has headed lower, but we're not oversold at this time. So technically right now, yes, we have pulled off the all-time high. We did have a negative week last week, but there's nothing to be really fussed about as far as the technical picture goes. Now, from an overall perspective of how investors are reacting to earnings in the market and economic announcements, that is a little bit of a concern. We'll talk a little bit about that later on. If we take a look at the price action for last week for the S&P 500, you can see on Monday we did have an up day, not a very big day. Initially, it felt like the old Mondays that we had back a few months ago. It seemed like every Monday was a vaccine announcement and the market would run up quite substantially. But we did have an up day. It wasn't substantial last week on Monday. Down day on Tuesday. And on Wednesday, another down day, big down day. This was the big surprise of the week. Here we saw the market actually coming into the Federal Reserve's announcement. Obviously, everybody expected Powell to hold rates steady, and that's exactly what he did. He was actually quite dovish in his talk as far as the announcements go, and the market still sold off and ended lower on the day. So quite a big down day on Wednesday. We also saw some earnings on that day as well, and we'll get into that. The market didn't react very well to the earnings that were coming out. On Thursday, we did see an up day. And then on Friday, we did see that big down day on Friday as well. Overall, it was quite a negative time for the overall stock market last week. If we take a look at the major market performance, the S&P 500 was off 3.3%. Russell 2000, was actually off, in this case, 4.4%. So this is a small cap sector. We've seen the small cap sector doing quite well. But not last week as the markets pulled off. Investors became a little bit concerned with risk overall. And also, too, we saw the emerging market sector head a little bit lower as well and underperform the S&P 500. The TSX Composite was actually was negative, but not quite as bad as the S&P 500 as well. And the NASDAQ was just a little bit below the S&P 500. If we take a look at major sectors of the market last week in the U.S., the materials sector was actually, I should say the energy sector was actually down substantially. The energy sector has actually been performing quite well, but recently showing some signs of weakness. We've at least seen volatility in the sector. From a seasonal perspective, the energy sector has its seasonal period start on February the 25th. And I've mentioned previously that January can be a very volatile time for the energy sector. And sometimes it's a good time to get into the before the seasonal period starts. But we did see some weakness last week in the energy sector. In the material sector, which is the sector right here, is also quite negative as well. Technology down not quite as much as the overall market. If we take a look at financials were down. The interest rates didn't tick up that much last week, didn't move that much, and the financial sector was down. A little bit of a pullback down here. Real estate and utilities and healthcare and consumer staples. So all the fairly defensive sectors or interest rate sensitive sectors actually did better than the overall market. If we take a look at some of the subsectors of the market and look at this is totally unusual for what we've seen here. This is the retail. This is the retail sector, and this is using the retail ETF XRT. And this is the granddaddy for the sector. And last week it was up 17.6% for the retail sector. And there's a reason why. And that's because last week, and I'll go into a little bit more, last week at one point, GameStop represented approximately 10% of the holdings of XRT, which is just a huge amount. So we saw XRT move around last week substantially. In fact, if we take a look at this position here, you can see here with what was happening. This is XRT relative to the S&P 500. Yeah, sure, it's been going up, and we've seen this spike going up here. Let's move in a little bit closer here. I mean, this is trading like a a small retail company or something. This is not typically what you see with the retail ETF. We saw that big, huge spike going up and down. So we saw some 10% moves last week in intraday for this particular ETF. And overall, it was up fairly substantially. If you take a look at this here, silver was also up as well. I'm going to talk a little bit about that later on because of what's happening in the silver market. So we did see silver actually tick up. Gold was negative, but this was really a response to a lot of the Wall Street bets crowd from Reddit actually starting to talk about silver to force people to buy from the short position, to cover their short positions. But if we take a look at the metals, were down quite substantially. So I mean, usually if you see gold down and metals down, silver is usually also a little bit soft, but that's not what happened last week, as it got this really unique interest as the Wall Street bets crowd started to talk about making the large banks that are short positions in silver to actually cover. And on top of that, we did see steel down quite substantially as well. If we take a look at home builders here, this was down quite a bit as well. But overall, the big story last week was definitely what happened in the retail sector, representing XRT. Here we had the U.S. 10-year Treasury yield, and it was slightly up last week from the week before. We've seen this tick. We did see this downturn here and up, but we're still in that trading channel here as we move higher for the interest rates. And we can see here's last week, we did see this downtick and then go back up again. Overall, we have seen a little bit of weakness from the RSI, a little bit of momentum loss, but we really, it'll be more interesting if we see it break down below this trend line here and the implications for the market. We're still in that trading band for the 10-year yield. Here's GameStop. Okay, so GameStop is last week it closed at $65 and just $65.10 or 1 cent. And that was after trading at, I think it was $2.80 back in April of 2020. So less than a year ago. And, everybody's saying this is crazy times, including myself. And then last week we saw it go all the way up to $4.96 as we saw, the Wall Street bet crowd really try and force GameStop's hand. And lots of stuff going on with that overall. So I just thought I'd make a couple quick comments on that. It's people were calling me last week that I know that really aren't in the market and asking about, what's going on with GameStop? What's happening? And it's all over the news. The news channels that don't typically cover the financial news, and so there's a real interest taking place here. And if we take a look here, first of all, GameStop is a physical video game retailer. It's got approximately just over 5,000 stores in different countries, including Canada, which is known under with EB Games. So you see them in the mall, these small stores. You take your old games in, you exchange them. The overall platform, is not expected. It does do some online sales as well. This is actually from Reddit here. This is kind of crazy. Here's the everybody's looking at this little figure here, and I'm sure you've seen it out there. And what's happened is all these retail investors have formed together on Reddit and forced the short sellers, a lot of hedge funds basically, to cover their positions, which drives the stock higher. And on top of that, I won't go into detail, but there's also the gamma that takes place on the calls. The retail investors are buying as the call options go up in value. The market makers are actually forced to buy the stock to hedge out their risk, which drives the stock up even further as well. And so we've seen this exponential rise, and it's really being caused by this Wall Street's bets group. It's been other stocks as well, AMC. So what they're doing is they're short selling companies that are really badly beaten up, that don't have a good, healthy, fundamental, long-term, like this is going to be the next greatest company. So where the hedge funds have moved in and said, look, these companies don't have a lot of potential, and therefore short them short. And the one thing I do want to say is that, free speech, you're talking about this is all free speech, and it's become very political right now. But I do want to say that, yes, some hedge funds have lost a lot of money, and you're seeing that, people cheering on the small investor in this case, and saying, look, finally the small investor's winning, and the hedge funds. But in reality, the sad part is that there's going to be a lot of, there's going to be a few small investors who are going to make a lot of money and have made a lot of money, but there's going to be a lot of small investors that are going to lose an awful lot of money on this. When this does turn down at some point, and it will turn down at some point, I'll go over that in a second, but they're going to lose a lot of money, and that's a real sad part. If we take a look at this article that was put out by Bloomberg, GameStop shares almost always plunge following earnings reports. And this author here goes and takes a look and says in the last 9 of 10 times, GameStop actually is corrected coming into earnings. Oh, guess what? The next earnings is March the 26th. Okay, so if it lasts that long, as far as the heights go here, I mean, it's whipping around all over the place. If it does last that long, that's the day to mark on your calendar and say, oh, okay, let's take a look and see what happens. There's nothing like a good earnings report to bring a little reality to a sector of the market or a stock like GameStop. And as I mentioned earlier here, this is the top holdings of the State Street Spider retail ETF, and that's XRT. And this was on January 26th. You're looking at a position of 9.53%. Now, this ETF is modified, equally weighted ETF, but it doesn't balance every day. So it'll have certain parameters. And if you take a look at all the other holdings, there's 1.9, 1.6, 1.4, 1.4, and here's GameStop up at 9.5. So it has to get to that perspective, that time where it'll balance as well, which actually, depending on how many other funds and when they balance, actually might cause a little bit of depending on what's happening in the market, also might cause a little bit of an issue for GameStop as well. Okay, so the Wall Street bet crowd, went after AMC and BlackBerry, so they're going after other heavily shorted stocks. Now, a lot of the stocks didn't have good fundamentals, but what hit the boards last week at the end of the week was on Wall Street bets was silver. And the reason why is because silver is shorted by a lot of large banks, and you can short silver without actually owning it. So the short sellers and the hedge funds, what they were doing for GameStop was they were actually short selling, borrowing the stock and then selling the stock, which forced them to buy it back. But it's possible in the silver market to actually, sell silver you don't have. And so there's a large position as far as shorting silver goes. And so what you're seeing on the the Wall Street bets crowd is you're seeing that, they're saying, well, why not go after silver? And it actually makes a lot more sense, at least from the perspective that it might be substantially undervalued. It's hard to argue that the valuation for GameStop was substantially undervalued when it was trading at, let's say, $10 or $20, that it should be at $500 now. It's hard from a valuation perspective. It's hard to do that. But silver, at least some people will say, well, silver is grossly underpriced, and it's also there's a large short position. So it'll be interesting to see what happens. The problem is silver is a much bigger market and will be much more difficult for the Wall Street bets crowd to actually come in and really have a big impact as far as that goes. But it's starting to hit the boards, and maybe they'll get a little success if some of the other institutions actually come in and go, you know what, we're going to start demanding also physical delivery. And that's the thing. The thing is the paper market for silver, and there's a physical market. And right now, the paper market is hugely influential over the actual physical market. But if a lot of investors start demanding physical silver, it can actually start to control the price of the paper market. And that's really what the Wall Street Bets crowd is after as well. So we'll have to see if that takes off from that perspective. Much harder to do, I think, than GameStop. Microsoft earnings. If we take a look at Microsoft earnings, this was actually one of the highlights last week. So Microsoft, if you take a look at their performance right here, let's just go here for Microsoft. I want to go back and take a look. This is relative to the S&P 500. From July, we can see this underperformance for Microsoft relative to the market. Now, Microsoft is really thought of as a, almost like the utility company for technology, because it's got this huge annual revenue stream coming in because of its business operations and an ongoing stream of revenue, and also pays a dividend. It's a very mature company compared to a lot of other companies. So it's like the safety stock. It's almost become this, and it's done extremely well at the same time. So, but we did see Microsoft last week, and let's just zoom in here a little bit here. You can see here that Microsoft reported their earnings on the 26th. So here's the 26th. After the 26th, the price of Microsoft relative to the S&P 500 actually increased in value, which was actually a positive compared to some of the other companies last week as well. So if we take a look at AMD, this is an interesting one. AMD actually had some really good results, but if you take a look at the reaction, and this was also a Tuesday report. So if we take a look, here's the 26th for this, and look at this. So relative to the S&P 500, it rallied into its earnings, and after its very good earnings and outlook, it actually fell. So what you saw last week was you saw the stock market actually, a lot of the stocks, even with good earnings, were actually falling as well once they started reporting, which is not a good sign. Typically, you want to see the stock market or stocks in the market, when they report their earnings, when they come up with good results, actually perform well. And their earnings have actually been pretty good across the board overall. But investors are getting a little bit jitterish right here, and they've sold off some of the companies as they've gone into earnings. Starbucks also last week, sales miss. Okay, and what you're seeing is you're seeing companies actually. Starbucks locations in downtown cores in the business districts not doing well, obviously, because a lot of people aren't going to work. So customers that affected Starbucks last week. McDonald's was actually fairly good last week after it reported its earnings, which was interesting. So it actually ended the week a little bit higher after reporting its earnings. Boeing's had such a tough time over a long term, last couple of years, for obvious reasons. It reported a record annual loss here as well, but it actually stabilized after its earnings. If we take a look at that, Caterpillar reported its earnings on Friday, and also did okay on the earnings. But what we did see a trend. It didn't matter if it was some of the other large companies that reported good earnings. Facebook, we saw investors actually start to sell off the shares after they reported earnings. Rogers Communications misses revenue estimates as a media business hit, obviously because of with the sports franchise. Being a detriment to them in the COVID times as well. So let's just take a look at Rogers, and this is in the States relative to the S&P 500. Being fairly flat relative to the S&P 500, but let's zoom in here a little bit. If we take a look at the 28th, look at this drop on the earnings. They got absolutely hit because of their poor performance overall. And as well, I do want to point out that Rogers, from a seasonal perspective, is in my book. I included that in my 2021 Investors Guide, and I'll just show you that right here. And so here's Rogers. You can see here that Has a seasonal period on April the 19th to May 23rd, tends to do particularly well. But if we take a look at the month of February, it tends to be one of the weaker months. The bar is the average, and the cross is the median, both a negative in the month on average for Rogers from 1996 to 2019. And it's only been outperformed the S&P TSX Composite 25% of the time in February. Now, it's had that big drop already, so it may actually not, may be okay here, but on average, from a seasonal perspective, it is a little bit weaker. And even over the last 5 years, you can see that black box here, so it's below the diamond, which is the TSX Composite Index as well. So we have seen some weaker performance. And if you know, the best month of the year tends to, on average, be October for Rogers. If you're interested, you know, there are other. October to November is a strong seasonal period. Plus, we do have that other seasonal period. It's a very short seasonal period. Now, Rogers can do really well at other times of the year, but this is when it tends to do better than other times. This tends to be the sweet spot for when it does well. And February is not one of those months overall. What to expect in the upcoming month here? You can see that the big news is going to be the non-farm payrolls from an economic standpoint, expecting 20,000. So the first Friday of the month, here we go. Let's see how the market reacts to this. So we've seen investors react negatively to strong earnings. We've also seen investors react negatively to the Powell's speech after the Federal Reserve meeting as well. And let's see what happens with the non-farm payroll. Because if we keep seeing this negative reaction, it'll actually say that the market could be a little bit weak. And we're going to talk a little bit about February overall for the stock market. ISM manufacturing coming out as well, total vehicle sales. ADP comes out once a week, but on the first week of the month, it's always good to look at that to give yourself an idea about what could be happening as far as the non-farm payrolls go. We have some strong earnings, some big companies reporting earnings. On Tuesday, Amazon, Alphabet, Pfizer, Exxon, Amgen, UPS, Lennox here. So quite a few, there's obviously more companies reporting on Tuesday, but some of these key companies, a lot of people will be taking a look at Alphabet or Google, also Amazon as well, Pfizer. So we're getting a little bit of a cross-section. On Thursday, some of the big companies, Merck, Clorox, Philip Morris, Gilead, Suncor, Unilever, Peloton. It's going to be interesting to see how Peloton does, just with its large valuation and what they come out as far as their forward guidance. So we are looking at another week of earnings coming out that I think are going to be fairly influential in the market, and they really, in the end of the week, we'll have that big non-farm payroll coming out as well. But I want to talk about February. If we take a look at February tends to be one of the weaker months of the year for the stock market. The February here. So February, since 1950, and for the S&P 500, as far as the ranking goes, compared to all the other months in the year, is the 10th best month. So in other words, it tends to be one of the weaker months on average. Now, we're still in that strong seasonal period, the 6-month period for the stock market, but this tends to be the little bit of hiatus that can happen. Now, if you take a look, it doesn't mean that this year the stock market is going to go down in February, but we can see some downturns. And in fact, if you take a look at over the last few years, and we'll take a look at the S&P 500. Last year, obviously, we saw that down year with COVID-19. And then if we take a look at 2019, positive, and we had negative, positive, negative, positive, positive, positive. So we see, even back in the earlier in 2011, 12, 13, 14, we saw these positive years also taking place. So it doesn't mean it's going to be negative, but it can be one of the weaker months of the year. So you have to be a little bit careful and watch out for that. Also as well, from the overall from 1990, if you take a look at the sectors of the market, which ones tend to do well. And the top performing sector on an average gain here, because this is ranked by average gain, has been the material sector. And usually you find the material sector starting to perform well towards the end of January. Excuse me. It's only beaten the S&P 500 by 58% of the time. as well. The consumer discretionary sector tends to perform well. You have to be careful, though, with this one because of what stocks are actually in here and how much of an influence they have. For instance, Tesla is about a 15% weighting in XLY, which is a big ETF for consumer discretionary. So depending on your overall perspective as far as Tesla goes, that's also an important factor as well. Interestingly, the consumer staple sector has produced an average of 0.5% gain, which is better than the S&P 500, which is 0.1%. And it's been positive 48% or almost half the time. So the consumer staple sector, although this isn't a strong seasonal period as far as a bigger seasonal period goes, the consumer staple sector can actually do well here. And if we see this consumer staple sector actually performing well, this will actually indicate that the market's becoming a little bit risk off. So watch that sector overall. I think that's important. But if you take a look at the bottom here, utilities, telecom, healthcare. So typically the other defensive sectors tend not to perform as well. They tend to be at the bottom of the ladder here. If you take a look at some of the selected subsectors, the semiconductor sector tends to do well. Silver tends to do well. So we talked about silver earlier on. But it tends to be one of the better performing sectors. The retail sector and tends to be outperform the S&P 500 71% of the time from 1990. Once again, there's a lot of factors with COVID also too as well, what stocks are on which ETFs as far as that goes and how they perform. But as a broad sector, perhaps on a truly equally weighted base or a cap weighted base where you're in larger cap companies, it tends to be a better one of the top performing sectors. Metals and mining, gold, chemicals as well. If we take a look at the bottom, biotech tends to be one of the weaker sectors, pharma, and also to home builders. So home builders actually peaks at the beginning of February. So here we are right now towards the end of the seasonal period for home builders. So February actually is going to be another interesting month. I mean, every month seems to be interesting these days with what's going on out there in the markets. But overall, we are still in that strong 6-month period that lasts from the end of the end of October into the beginning of May. But on average, February can be a little bit weaker. So something just to be cautious. I think the big concern right now is investor reaction to the announcements taking place. That's a little bit concerning. And we'll have to see what happens as far as the market, if it can get traction and that can turn around where investors start reacting positively to any announcements. And whether they're stimulus announcements or whatever it is, we want to see some positive reaction to that. And we just haven't seen that recently. So we may see a little bit of a softness here. Typically at this time of the year, you tend to find some of the cyclical sectors starting to do well, whether it's industrials and material sectors. But they've pulled off relative to the S&P 500. So the reflationary trade really took place in the fall time. Everybody's really pumped about that reflationary trade. That's lost a lot of its momentum. And you've seen some of those sectors pull back here. But we're still looking, because this is their seasonal period, for them to actually start to perform well and outperform the S&P 500 on a consistent basis. That would actually be a positive sign that the market's getting back in sync. We're not there yet. The market's still battling stuff out here, but we'll have to follow along. And we'll, this week, the first week of February, should give us some good clues. Thank you very much for joining me.